Hello everyone. I know it's already been time since I recorded a video, and the next time when I wanted to record a video, I wanted the topic to be an interesting topic, but I was not getting the correct ideas. But today, as I was scrolling through random animal videos on National Geographic, and I happened to watch some of the videos on YouTube as well, being inclined towards what I watched, an idea struck me that I could probably record a video to capture upon the animal references that are used in the stock market, which is very interesting actually, and it is just not restricted to the common terms used in the stock market in general parlance, that is bear and bull, which already a lot of you would be knowing. So I think it could be, I thought it would be an interesting presentation. Let's start without further ado. I hope you enjoy. So as you already know, the term bull, bulls are those kind of investors that are optimistic. Already would have seen the web series or the movie The Big Bull, and the references that we hear generally in the stock market. Bull is nothing but an optimistic investor who thinks that the market is going to be in an uptrend and tries to invest more and more into the stock market because he or she is highly confident that the stock market is going to be in an uptrend, and they are the reason why the share prices rise as a result of infusion of more and more funds into the market. Again, the next animal that you can see on the screen is a bear. Now, bear is simply the opposite of bull. Bears are pessimistic and they expect that the market will never be in an uptrend. It will always be in a downtrend, and so they try to profit from the shares going down, probably by short selling the shares or selling the shares early. I mean, whatever way it is, they try to benefit from the selling of the shares. So, and they are completely pessimistic. They are not at all optimistic like how bulls are. And they are the reason why the share markets or the share prices are always in a downtrend. Next animal that you can see in the screen is a rabbit, of course. So, I'm sure a lot of people would not know about this term. Rather, you would know about bears and bulls, but not a rabbit. That's what I assume maybe you would be knowing. So a rabbit is a kind of investor, or the term given to an investor who tries to stay in the market for a very short span of time. So he or she doesn't want to be a very long-term investor. They want to stay in the market for a very short span of time. They enter, they make a trade in the early morning or in the afternoon, and they sell the shares in the same day because they like to sleep peacefully, because they do not want to worry about the fact that the share prices are going to fall the very next day, so they are in tension or stress. So they are the ones who know that the share is going to go up during this day, so they buy the share and they sell in the very same day or for a very short span of time. So they are not involved too much into the market for a very long period of time, so they are not long term investors. Next is a turtle, not to confuse it with a tortoise, though the meaning could imply the same. So turtles are basically long term investors. I would like to call myself a turtle, but I mean, I see, interlinking characteristics which I can feel from the other animal references that would be coming up. So I would not say I'm completely a turtle, but yeah, somewhat. So turtles are long-term investors. They like to, go at a slow pace and they are very calm. Unlike rabbits, they like their sleep to get affected from the stress that is going to happen in the future. So they are not at all concerned about the volatility of the stock market. They are long-term investors. They know that, so kind of a bull, you can say, a little bit elements of bull, but bulls are more enthusiastic. I would say that these people are a little more calm. So turtles are basically, they are long-term investors. They are very calm and composed, and they know that the market is going to go up in the long term, and so they invest on a long-term investor perspective, completely unlike rabbits. Okay, so this is a pig. I mean, a pig is actually the biggest loser of the stock market. Pigs are nothing but, a lot of you would have watched this web series called Scam, which was based on true life events on the character of Harshad Mehta. So in that web series, you would have seen a scene where the liftman asks Harshad Mehta for a tip, because he doesn't know anything about the stock market. He simply asks a tip in which share to invest, and Harshad Mehta gives him an advice: ki you buy MRF or something like that, which was a rubber-based company. I do not recall the name exactly. So pigs are basically those people who are like those like that liftman, who basically rely on the advice or a tip given by a person who's already involved in the stock market. They have no opinion of their own, and as a result, they are the biggest losers in the stock market, and they end up losing a lot of money, which you will find a lot of masses in today's economy being pigs. I mean, I'm sorry, that's a very harsh statement, but I mean, you will find. So that's all about pigs. Okay, this is an ostrich. So what are ostriches basically? So when there is a bad, bad vibe going on in the market, there is a bad news that is prevailing in the market, these ostriches try to bury their head into the ground. So they feel whatever the bad news is, it is just temporary. I have done well. They have a lot of overconfidence in themselves. I have done well. Let me, put myself into the ground so that I am not concerned about the bad news because it is temporary and it will go away. So these kind of investors are called ostrich, who are probably, not trying to be risk averse, though they are risk averse. Okay, so that's a chicken or a hen. I mean, whatever what you want to call it, but generally the term used is chicken. So chickens are basically completely away from stock market. So you will find the older generation people in your house who will always tell you to invest in FDs, RDs, or investments that give you fixed returns. Those are chickens, and those are hens. They are completely away from stock market. Whether that's a good thing or a bad thing, that's subjective, because I mean a lot of people, there can be speculations or discussions about the same. But hens are basically away from stock markets. They will invest in more safer modes of investments, like government bonds and FDs and savings account. I don't know if you can call those investments or not, but whatever it is, I mean, in a way. So these are people who are basically chickens. The investors who are basically chickens. That's a sheep and a collect. All of you have learned collective nouns in your school level, so you would recall that the collective noun for sheep is a herd, and we generally refer to as herd in our daily lives by when somebody is following the masses, we refer to that as the herding effect. So you can understand from the meaning, or the collective noun of sheep, that what a sheep kind of investor would do. It would, whatever the others are doing, they would do the same. They are following the herding effect. They have no opinion of their own. They try to just follow the masses. Whatever somebody, if their friends tells them that buy this stock, they will buy, or they will see their friend buying some stock, they will buy. So these kind of investors are basically sheep. Okay, so this is a dog. A dog kind of investor would be somebody who likes to, I mean, dogs are actually not investors. It's a kind of security that is referred to in the stock market, a kind of share. The shares that have lost a lot of value in the share market, and they are trading at their lows, that is referred to as a dog stock. So basically, but these stocks are, they might be trading at the very down price, but they give you good dividends, and that is why there is a term that you'll find in the US, very prominent, that called the dogs of the Dow. So dogs of the Dow is basically the top 10 dividend yielding shares that are there in the Dow Jones Industrial Index, which investors try to pick up to get a regular source of income. And since they pay out a huge amount of dividend, and regularly, there is stability in these stocks, and that is why the share price also trade at a low. Because I mean, a lot of you who would have studied finance would know that if a dividend is given by a company, their share price decline to compensate for the extra income that they're getting. So this is a dog stock. This is a wolf, and wolf investors are basically very strong, very knowledgeable, and people who are there just to gamble and make money out of the market. They come into the market, they try to engage into malpractices of market manipulation, and there could be a lot of things they try to do which are not ethical. But since they are knowledgeable, they're enthusiastic, they are rich, they can try to control the market. And just like the Harshad Mehta, I mean, that's a very good reference for all of you to understand, because a good web series has been made on it. And a lot of you who would have not watched it, I would request all of you to please watch it, because it would give you a lot of idea about what could happen, or what you could do into the economy, and what could happen in the economy. So wolf investors are basically those kind of investors. So I think, yes, that is it from my side. But I would also like to give you a bonus in the sense that there are also other kind of animal terms that are used, be it a whale, be it a shark. So, but all those characteristics are not so interesting to discuss. So that is why I have not incorporated those in the slides. But I feel some research work can be done from your end if you're interested to actually know about what's going on and what's not going on in the market. But I hope this video was useful, and I tried to present it in a fun way, which was more interesting, and you were inclined to watch till the very end. Thank you so much for sticking till the very end.